Now back to how Japan might fuck our economy. Because if one of the largest historical buyers of United States Treasuries stops buying, then yields have to rise to attract new buyers. And that's how supply and demand shape long-term bond yields. But that's also how you can get a situation where the Fed cuts the federal funds rate, short-term yields fall, but long-term yields stay elevated, and that's how you get what's called a steepening yield curve. And if this happens and long-term rates stop cooperating, then it stops being just a bond market story, and then becomes an everything story. Because when analysts build models to value stocks, they discount cash flows using long-term yields as a baseline. And when long-term yields remain elevated, the present value of future cash flows in these models decreases, which means valuations compress and stocks trade at lower multiples. So even if earnings are fine, the price investors are willing to pay for those earnings changes. And that's why markets can suddenly feel unstable, even when the headlines look calm. But it doesn't just stop at the stock market, because the 10-year Treasury yield isn't just some nerdy number on Bloomberg. It sets the price of money and is the foundation of nearly every asset valuation. And mortgage rates are another example of this, because, like stock valuations, mortgage rates are largely anchored to long-term Treasury yields. So, if the 10-year yield doesn't meaningfully fall, mortgage rates don't magically drift back to 3%. So the Fed can cut the federal funds rate all they want, but if global demand for treasuries weakens, then the long end of the yield curve stays pinned. And when that happens, mortgage rates stay high, housing affordability stays strained, refinancing activity stays muted, and home transactions slow. But it's not just mortgage rates and equity valuations, because if you zoom out even further to corporate credit, it's the same story. If you remember back when